Good afternoon, friends. Happy Monday to you. October 17th is in the house. We'll make some things happen today. Kind of a slow day news-wise. We're having trouble streaming to Facebook. I'm getting notifications. Having trouble streaming to Facebook. Initial Facebook said. Ha. Is what it is. Let's get to it. Going to break down the facts, the fiction for you today. This is one of the things that has been happening. A lot of people believe that there's a surge of riskier loans taking place. And it's really just not the case, especially if in comparison to if we go back to the financial crisis, the Great Recession, and what happened there, which there was a tremendous amount of that going on, an absurd amount of that going on. Is there creative financing in the marketplace? There always will be. Do banks come up with new ideas when mortgage apps fall on traditional financing? 100%. They do. But the context behind the creation of what we're seeing right now is based on common sense. And so that's a good sign. And what I mean by that is you're seeing them do things that make sense. And before the crash, it was like, oh, okay, well, do they have a 600 credit score? Okay, cool. Then no money down. It was just bananas. Now you have to have down payment. You have to have skin in the game. You have to meet tight financial scrutiny and income criteria. So it's nothing like that. And so I see headlines like this right off the bat. It's like, okay, demand for riskier loans surge as interest rates soar after refinances go away. And that's not really true. Those loans aren't necessarily riskier. They're not necessarily riskier. In fact, I mean, you tell me, if you had, let's say an asset depletion loan, or you're asset financing something, but you're putting 40% down, is that a risky loan? Is it? No, it's not. An FHA loan, none of the loans we're talking about right now are riskier than an FHA loan. So it's just funny to me that, I mean, not even close. It's just funny to me that you see these headlines, but that's why I always try to truth spray on those. Bank of America CEO, Brian Moynihan, came out and basically said, hey, spending and savings data show the U.S. consumer is healthy, meaning that people are still well off overall. And this is one of the things I was alluding to prior to the downturn, which we've experienced now, which is very real. We are experiencing a true and real downturn here. It's not a significant one. It's not a crash, but it is a correction. We're seeing a pullback in prices. It's all interest rate related. We're going to take a look at some stuff on that here in just a second. So, but leading into that, what I was telling you was we had record household wealth just a few months before this turn began. Record household wealth, historic record, all-time record. Household wealth, that helps a lot in these times. It really, really does. It helps a lot where people were not truly leveraged. You say, oh, well, credit card debt was at an all-time high. Student loan debt was at an all-time high. True. But with respect to savings, with respect to assets, not anywhere close to all-time highs on the ratios. So Moynihan just kind of confirming that, hey, everything looks pretty good here as far as what we can see. Now, however, that doesn't mean that that the road is clear. And this is, I agree with Jeremy Siegel on this one. The Fed waits for core inflation at 2% and drive the economy into depression. Very true. If the Fed continues doing what they're doing, if they continue to raise, it's all these red arrows here. The red is the Fed. Okay, that's why I chose red. Rhymes with Fed. I know. No. Hold the applause. It's fine. You can laugh. But you can see here what they've done. This is strengthening. This is the dollar. So this is the DXY. Strengthening the dollar weakens everything else. Today, the dollar is down 1%. And that's why you're seeing strength everywhere else. So this really is the key. This is the key graph. This is the key metric to track. This is the key to the financial city of America right now. And honestly, it looks like there's quite a bit of weakness here. We had a rejection. Let's zoom in a little bit closer on this. You want to get real technical with it. We've got a rejection here at the midline here. So a nice rejection. Looks like probably a 618 retracement there on the slow time frame. Yep, 618 right to the golden pocket, and then rejection from that, which is a continuation. So we might be testing the lower levels of this here soon. Now, when the Fed stops raising rates, what'll happen is this will die, and all of this over here will go nuts. So that is what kind of the next step is. And the question, we don't know when that's going to happen, obviously, but we do know that those things are correlated. And when this gets killed, all this stuff's going to go green and go bananas. And what's interesting about that too is we can kind of expect mortgage rates to do the same. Now, I'm not doing jumping jacks today based off of this candle here, this higher wick. I'm not a huge fan of the fact that this downtrend is still in play and we appear to have rejected off of it in this situation. But I'll take 30 basis points. Take that all day. Very quiet day, which means usually something explosive is on its way. Now, a couple things to note here. Yes, the downtrend held, but take a peek. Higher lows, okay? Higher lows for the day. This thing is stair-stepping its way. It's trying to bust through this, break out, and create lower interest rates. This is the key to the whole thing. Would you believe me if I told you I spoke to a woman last week, pre-approved her for a loan, no problem, a VA loan, husband's a veteran. They've been renting for 30 years. That's right, 30 years. Landlord calls and says, we're going to sell. We'd like to sell to you first. Imagine that. Imagine being a landlord. Someone else pays the house off, makes the payment for 30 years for you. And then at the end of the 30 years, you go, hey, want to buy the house? They already bought it. They paid for it already. That's the power of owning real estate, summed up in one real story that is happening right now in my life. And they're easily qualified. So, yeah. Right now, though, a lot of buyers are spooked by this market because of the payments that they're looking at. We are very much a payment-driven society. We're not a price-driven society. If we were a cash society and not a finance society, we'd be more price-driven. We're more payment-driven. And when the market is softer, it's worse for sellers. Therefore, it's better for buyers. But a lot of buyers have trouble pulling the trigger when they look at the payment and go, I don't like that. That I don't like. I like the price. I just got an appraisal back in. VA buyer buying a place in contract 529, appraisal 550. People are buying stuff under appraised value, under list price. People are getting great deals on homes with upside. Upside being we can refinance in a year or two. I can't tell you how long it'll last. Maybe we have 3 months of this more. Maybe we have 6 months of this more. Maybe it's going to be a year or two. I don't know. I really don't. Anything could happen in financial markets. That's one thing I'm sure of. But I will tell you this. People who buy homes today will not look back on it 10 years from now and go, gosh, what were we thinking? That is not going to happen. That is definitely not going to happen. And hey, listen, I'm not just sitting here. I'm not the fluffy puff guy, okay? You up. That's not my role. I'm here to shoot you straight. Real estate goes up and to the right. Maybe we should pull that graph up. Let's do that. Average home price. Let's see if there's an update from Q3 on this thing. Because we're waiting to see if we were going to get an update. No, we still showing Q2. So I'll go ahead and put this in the description in the list. Long story short, though, 30 basis points gets us a little bit of bump. Rates improve a little bit. These rates are relatively accurate. I'm about 0.25% lower on those three options right there. The jumbo, the 15-year, the 5/1 ARM are about the same for me. But this is still the graph of real estate. Okay, reporting every quarter. That's still the graph. Now, a lot of people believe that, we should revisit some of these areas right here, that we experienced sort of the pre-COVID era, the pre-COVID highs. A lot of people were expecting that we would revisit that. Mind you, in order to get there from 525, we would need to, just to get to the top of that range, we have to get to 400. So what is 525 divided by 400? We need a 30% drop. Pretty significant. Not really. I don't think we're going to see that. Could we get somewhere in the mid range here? Possibly get back to the mid 400s as an average. I think that could be That's possible. You know what? Let's also look at Fed mortgage rates here. It's just Fed is just the St. Louis Fed. And let's see if we got a new reporting in here. Last time I checked it, I didn't like the number I saw. 6.92. So average now 6.92. You can see what it was last week, so I didn't like it. So I didn't talk about it. 6.92 is the average rate in the United States right now. So almost 7%. That also, markets tend to like round numbers. So let's say if you were, a bond buyer, a big fund or something, 7% sounds pretty darn good. Now, mind you, you don't need to lock up for 30 years to get a good deal right now in bonds. 2-year bonds are giving you over 4%. Now, ultimately, Wall Street and the government don't want this. They do not want a higher interest rate environment. It's impossible to run the government that way. And Wall Street doesn't want you to have easy, safe money. They want you to only be able to invest money to have a chance to make money. So there are some serious forces here that want this all to be over with soon. And they're going to do a lot of things to try to make that happen. You're already seeing the pressure on the Fed right now. Oh my goodness. They are under it, not just because there's elections coming in a few weeks and things seem to be softening and people don't like it and they don't like the movement and the action in the markets. And the Fed is under a lot of scrutiny and a lot of trouble, and they're not getting the inflation readings that they would like to see. We're not seeing inflation really move yet, but the problem is the Fed actions aren't going to impact inflation for quite some time. It'll take years possibly to see the effects of that, raising rates. But it won't take years to see the effects of what it does to the dollar and then what it does to all the other financial instruments out there. And this is really what we need to take a close watch of, because this essentially, the DXY here, this is the United States dollar versus the average currencies throughout the world. And so if we do see this is a possible downtrend here that maybe started. Now, the last time we had one of these, it didn't last long, but let's just take a look at that. I'm going to plot that right there. We're going to keep an eye on that guy. If that holds, okay, so if we get a retest and this holds, then we might actually break this channel. And that could happen if it is believed, or if the FOMC notes show like, hey, we're ready to take our foot off of the tightening. We're ready to take our boot off the economy's neck for a sec and maybe just not raise rates for 1 minute and see if that does anything. Because if they didn't raise rates, here's what I'll tell you. Inflation reading would be the same as if they do raise rates. It's not going to change anything. It's just not. The inflation issues are so much more macro and so far distanced from the just pure borrowing cost. Although that's not helping. It's not helping. But it's just so far away from that. There's so many bigger issues there that are involved. And a lot of them are actually things you would consider bullish, like underemployment. Some of these places, who are producing things, particularly food, they just don't have enough hands. Listen, I'm just shooting you straight. I don't care what the truth is. I just want to know what it is. And so if that is the case, and it sure appears to be, they don't really need to raise rates. And if that becomes a consensus, if that becomes a reality, first thing we'll see bonds rally, and we won't know why. We're like, whoa, bonds are rallying. Haven't figured out what that's about yet. And then a couple days later, we'll find out, oh, there it is. FOMC no longer down to pound interest rates and pound the market. So this is the chart. This is what we have to look at. This is everything to us. Now, as it stands, for people who want to take advantage, people who wanted to buy real estate, but it was too crazy, it was just too bananas. Like, you know what? I don't want anything to do with this market. I am out of here. Just get me out. There's a lot of people who were that way when things were crazy. Now that things have softened, there's also a lot of people who are saying, you know what? Push to the right, push to the right, push to the right, meaning we'll do it next year. We'll do it first quarter. We'll do it second quarter. We're looking at the summer of next year. And so that's stacking up buyers. That's stacking up bidders for the relatively near future. And these are people who are signing your leases, 9-month leases, 10-month leases. Are they going to sign another lease again if we get to this point next year? It's hard to say, but you have qualified buyers stacking up to the right, which bodes well for the bid, bodes well for the support in the real estate market, at least particularly here in San Diego. I can't tell you about that in other markets, but I can tell you here, there's a lot of people trying to buy real estate. There's a lot of people trying to get qualified for real estate. They don't like the payment. That's why we look at the 2-1 buy down. 2-1 buy downs paid by the seller. Sellers are willing to do that right now. A lot of them are, not all of them, of course. You can lower your interest rate the first year by 2%, the second year by 1%. The idea is by then you have the opportunity to refinance. If you don't, then you just have to pay the fully indexed rate. There's no other gotchas, no penalties, nothing like that, no fees you have to pay. And it's all fixed rates. But that's kind of the hack right now. And that is a gimmick product. It is. It's a gimmick. Sure. Tell you what it is. It's a gimmick. But every gimmick product actually has at least one use case. You could say the same thing about reverse mortgage, which has more than one use case. But a lot of times it's used gimmicky by people because they can make so much money with it. The 2-1 buy down is a gimmick, but it has a place, and this is its exact place. This is where it makes sense. When you believe that interest rates have had an overreaction, have gone too high too quickly, not likely sustained at these levels, I want to buy something and get a lower purchase price. So I want to pull the trigger right now, but I don't want to pay that big old payment. And so you go in, you get the 2-1 buy down, and you don't pay that big old payment. You save a bunch of money on the payment. Do I have an example here? Like I did. Let me see if I can pull it up. I just did this for an agent who reached out to me and said, hey, we've got a listing here. It's listed 1.3. And we want to figure out how we can do this 2-1 buy down. So just a jumbo quote, 20% down. This is your loan amount. Plug in the interest rate, fixed rate. Look at the monthly savings. Almost $1,300 a month the first year. You're at 4.25. So you're buying a house in today's market where the average interest rate is 7%. You are paying 4.25% for the first year, 5.25% for the second year. And if rates remain high, then that 5.25 will still be a good deal. If rates drop down and you can lock in that rate or lower, let's say in year 2, you can go ahead and do that. You can refinance, and any unused subsidy, let's say you didn't use any of year 2 subsidy, it's almost $7,800. You would get that as a credit that would get credited back to you. So it is a gimmick product. It is, but it has a place, and that place is right here, right now, where buyers want to get the price they want. They don't want to pay that full payment. They want to pay the lower payment. And it's understandable. Look, even when you buy a house, if you ever have the opportunity to do this, it makes sense, for a lot of first-time buyers, because you get to save some money that first year. When you buy a house, there's all sorts of things you want to do. Put stuff on the walls. Hey, you want to make a workout room here. You want to buy a piece of furniture over there. We want to build something here. Want to add this, whatever. There's all sorts of things. So have some extra cash that first year can really make a big difference. And so it's not a bad thing. There's no real downside to doing this program. But it's sort of a push. It's sort of a punt overall, because the seller could just give you this money that they're subsidizing, this $23,000 in this scenario, off the purchase price, and it would be the same to them. So you could get a lower purchase price. But if you're buying this thing under appraised value to begin with, and you want to go ahead and get some money that you can use to lay it out in such a way that you're still paying what you want to pay, then it does make sense. So just something to keep in mind. We are live. I don't think we are. We're not on Facebook right now. I'm getting all sorts of error messages, so we're not live on Facebook. We are live on LinkedIn, YouTube, Twitter. I'll figure out Facebook for tomorrow. Let's see what Jay says here. Mr. Jaybrid, do you agree with Barry Abib's predictions of 5% Q1 2023? I don't know about Q1, but listen, Barry is the oracle, right? He is Neo. He's the guy. So he knows more than me. I'll tell you this, though. I think that's too soon. I think it's too soon. I don't think we get the pivot quickly enough. I think the market makers are doing very well in this market. They're chopping up a lot of retail investors right here. They're liquidating a lot of people right here. They're making good money right here. So I don't think we see necessarily that pivot happen that fast, but it could. I would say that is probably the fastest possible. 3 to 6 months is what I'm saying. That's the most optimistic outlook. 3 to 6 months, which fits right into Q1. So most optimistic would be Q1. And it's hard to disagree with Barry. This guy has called so many tops and bottoms in bond markets. I mean, if he says Q1, then I'm going to go from saying that that's my optimistic prediction to that's my neutral prediction. That's how much pull and how much credibility Barry Abib has. He's the one who runs this website. This is his website right here, mbshighway.com, where you can, if you want to see and you want to track mortgage bonds, you can go and you can subscribe to that, and you can get the feed. You can check it out. But yeah, he's a genius, literal genius. And overall, we don't have a whole lot to show you here. That we don't have a Q3 update yet on house prices. We're seeing here, we've just gotten 6.92, almost 7% on interest rates, at average interest rate. So if you think about that, you would think if rates were going to go from 3% to 7%, remember rates were at 3% January 1, 3% to 7% in 9.5 months, you would think the market would absolutely tank. It's not tanking. It's just not a frenzy anymore. Sellers have to be realistic. I'm hearing a lot of listing agents telling me, hey, I helped these people buy this house 3 years ago for $750, and now they won't take an offer for 1.2. Sellers, you have to screw your heads on right here. You're up huge on some of these deals. Don't look at what it would have sold for 6 months ago, because that's gone. That is gone. And if you are going to look at what it would sell for 6 months ago, look at what it would have sold for 6 years ago. Realize how far you've come. It's a greedy mistake that can be made by sellers. It can really cost them a lot of money, particularly in a market like this. So sellers out there, you got to be very, very careful here. Listen to your realtor. If you don't trust them, if you think they're a bozo, then fire them. But you have to listen to them. Hire someone that you trust, that you're willing to listen to. If you aren't willing to listen to them, they need to go bye-bye. Just that simple. Give them the heat-fo. I need to get a new soundbite. You're fired. Get rid of them. Okay? Find someone you trust. And then when you find that person, listen to them. Okay? Your realtor can earn their money here big time, but you got to listen to them. At the end of the day, it's your decision. It's your home. Got to listen to them. A lot of people leaving money on the table because they're not taking off. Oh, that's just our first offer. Usually your first offer is your best one. Remember that. It's our first offer. Let's see what happens. Those people go away. They go bye-bye, and now you got nothing. So just be careful out there, okay? Lots of opportunities for buyers. The stuff I'm talking about there, that's bad for sellers. Remember, bad for sellers, good for buyers. If you're a buyer, ask yourself this question. Are things better for sellers right now than they were 6 months ago? The answer is an obvious no. So if it's not better for sellers, you got it. It's better for buyers. However, because this drawback has been caused by interest rates, what buyers are not seeing is they're not seeing lower payments. They're going, man, well, we were pre-approved at 3.5%, last year this time, and we were able to buy so much more house. Now we're pre-approved at 7% and so much less house purchase price wise for the same payment. And that's true. It's very, very true. But if you had bought a house a year ago with that lower rate and the higher price, that would have been that. You would have no upside, no benefits, nothing good coming. It is what it was. You're never going to refinance. Today, you buy the house, you get the lower price, which is the most important. What's more important, price or rate? Which one is more important, the price you pay or the rate you pay? The price is more permanent. That's why it's more important. The rate's obviously important too, because the payment's important. But price is more important because it's permanent. Rate is transient. Rate can change. Rates will go down. Rates can be refinanced. The price is permanent. So it's better for you to get a permanent fix lower, because now you have upside. Now you have the ability to refinance in a year or 2 or 3. I don't imagine it'll take longer than a year before people refinance who are buying now. But when that happens, now you have upside. So when you buy a house today, look at the 2-1 buy down calculator that I've got available. I'll email you a copy if you want. Just request it. I don't care if you're an LO or whatever. I'll share it with you. Look at that And then look at, well, what would my payment be if rates were the same as they were, not at the very lows, but maybe back, before we had like the COVID lows. Just go pre-COVID. Just look at that. Look at the pre-COVID lows. What if rates dip back to that? What if we had 3% VA FHA rates? What if we had 3.75 conventional rates, 4.25% investment property rates? What if your rate went down to that? What would the payment be? So consider that into the equation. Hey, this might be what I'm able to get on this down the road. Doesn't mean you'll be able to, but just so you have a full picture of what's possible, complete the circle. If you get narrowly focused on, well, that's what the payment is today, fully indexed, that's what I got to pay for forever. No, I don't want it. There's no way in the world, if you buy a house today, that you are going to pay the payment that you get today forever. It's just no way. Unless you lose the ability to finance. Your credit goes in the toilet or you lose your job or something. But if you're in the same capacity as you are today when you purchase your home, financing wise, there's no way in the world that you will keep that loan for more than a year or two. I mean, 3, let's call it absolute tops, worst case scenario, but probably more realistically less than a year. So people are not making decisions. They're not buying homes that are priced extremely well for a payment that they might only make 7 or 8 payments on. That's what's happening right now. That's why there's opportunity, because people are looking at that payment and going, I can't make that payment for 30 years. You won't have to, but I understand why you don't like it. People who can see past that are the ones who are getting deals, like my buddy who just got 20,000+ instant equity on that appraisal I was telling you about earlier. So long story short, every penny does matter here. All these strategies I'm talking about, I can help you, your friends, your family. Give me a shout, text, call me, email me. I'm not a busy guy right now. We do not have a lot going on. I have plenty of time to go through things with you in a thorough fashion as needed, and will happily do so. It's a type of market where there is opportunity. I want you to fully understand what that means for you, particularly. Run all the numbers, look at everything. And if you need a great agent, let me know as well. Depending upon where you're looking in San Diego, I can connect you with somebody who is top notch. All right, guys. And also, do not forget, it's a Monday. We're in the fourth quarter now. Remember Santa Claus rally? That's possible. Look, what could be happening here. It could be a great setup for a strong finish to the year. Let's not forget that possibility. Things are doomy and gloomy at the moment. But remember, the night is darkest right before the dawn. It's so true with markets too. The market looks its absolute worst when it's at its absolute lowest risk moment. Never forget that. All right, guys. I'll be here if you need me. Have a great night.